decided to do my case study on the WorldCom accounting scandal. Here's the overview. I'm going to start out with the case foundation, then the primary ethical issues, then the proper argument, the professional ethical code, objections, and then I'll finish with my sources. In the late 90s and early 2000s, WorldCom was one of, if not the largest telecommunication companies in the world. They had grown so fast due to a series of acquisitions and mergers. The acquisitions and mergers were chaotic and unorganized, and this caused an extremely weak internal control environment. Upper management did not help the unorganized environment, and when efforts were made to create a corporate code of conduct, it was shut down by the CEO. With no enforcement of any ethical codes, the top management was recording revenue improperly to make it seem like WorldCom was still a growing company, even though they weren't. After it was all said and done, the SEC, Securities and Exchange Commission, said WorldCom had inflated its income by $3.8 billion. The downfall of WorldCom came because of the internal auditors. They look over the company's financial statements to make sure that they are following GAAP, which is generally accepted accounting principles. Cynthia Cooper, who was the vice president of the internal audit, found an unfamiliar account, and while asking personnel about the account, no one could give her a straightforward answer. When questioning the CFO, Scott Sullivan, about the account, he asked her to delay the internal audit. She went on with the internal audit anyway and went to the head of WorldCom's auditing committee about the fraudulent accounting. A couple days later, on June 25, 2002, the fraud was released to the public. Some of the main primary ethical issues were the CEO shut down the idea of creating a code of conduct which would have helped the company be more ethical. The upper management was improperly recording revenue to portray WorldCom as a growing company. The pressure from upper management to meet financial goals at any means necessary. WorldCom overinflating its income by $3.8 billion. And then upper management trying to ask Cooper to delay the internal audit when she asked about the suspicious accounts so they could cover up their tracks. I decided to use deontological ethics for my proper argument. Deontological ethics is all about using rules to distinguish what's right from wrong. Follow the rules focuses on the process, not the results. My ethical premises were an ethical person uses rules to distinguish what's right from wrong. If I act this way, then everyone has to act this way. My context is WorldCom overinflated its income by $3.8 billion, making them seem like a very successful company. WorldCom lied to millions of investors who ended up losing most of their money. Upper management knew what was going on, and when the internal auditor started asking questions, they tried to delay the audit to cover up their tracks. My formal argument is, according to deontological ethics, it was ethical for Cynthia Cooper to not listen to upper management and continue her internal audit due to the universalizability principle. If she would have delayed her audit, she would be saying everyone else in her situation has to do the same thing. The professional ethical code that I will be using is from the American Institute of Certified Public Accountants. Some of the important sections that pertain to the WorldCom accounting scandal were the public interest principle, which a member should accept the obligation to act in a way that will serve the public interest, honor the public trust, and demonstrate a commitment to professionalism. This did not happen at WorldCom, as they were using fraudulent accounting practices and lying to the public about their actual revenue. The next one is objectivity and independence principle. A member should maintain objectivity and be free of conflicts of interest in discharging professional responsibilities. A member in public practice should be independent in fact and appearance when providing auditing and other attestation services. This did not happen either until Cynthia Cooper busted them for the fraudulent accounting. And lastly, we have responsibilities principle, which is in carrying out their responsibilities as professionals, members should exercise sensitive professional and moral judgment in all their activities, and this did not happen because taking part in fraudulent accounting practices is not very professional. So for my first objection, I used utilitarian ethics. The upper management of WorldCom was doing the best they could to keep the company growing. They were making everyone money, including investors, so from a utilitarian ethics standpoint, it was unethical in Cynthia Cooper to not delay the internal audit due to rule utilitarianism. The long-run profitability would have done good for everyone associated with WorldCom. My second objection, I used ethics of care, and it was if Cynthia Cooper does not delay the internal audit and it gets out that WorldCom is fraudulent, then thousands of people would lose their jobs. So from an ethics of care standpoint, it was unethical for Cynthia Cooper to not delay the internal audit due to duty of care. It was her responsibility to follow a standard of reasonable care when making this decision that could cost thousands of her coworkers their jobs. And here are my sources.